We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on OXY, Occidental Petroleum Corporation, a major force in the global energy space, is dealing with a bit of a mixed message from the market right now. Morgan Stanley recently lowered its price target for the stock from $63 to $58, but still maintains an overweight rating. This suggests they still see potential in Occidental shares, just not as much as they did before. Despite that downgrade, the stock managed to climb 1.51% today, which might catch some investors off guard, given the revision. What's driving this? The energy sector as a whole has had a solid start to 2025, outpacing the broader S&P 500 by about 10%. However, Morgan Stanley updated its models, reflecting changes in commodity prices and reserve expectations for the year. For natural gas exploration and production, their price target jumped by 9%, which is great news for that segment of Occidental's business. But for oil, the outlook is a bit less rosy. Oil E&P targets were reduced by about 11%. Well, it's definitely interesting that Occidental stock is seeing some positive movement today. Even in the face of a price target cut, investors will need to be cautious. The oil market is still in a bit of flux, and those commodity price swings could heavily influence Occidental's performance in the short term. So, even though the energy sector is showing promise, it's clear that oil prices are still a big factor in how Occidental's future plays out. Keep an eye on that balance as the year progresses. Our review on CVX, Chevron Corporation, a major player in the global energy industry, continues to expand its footprint in natural gas exploration, and the latest move is an exciting one for both the company and investors. Chevron has shown interest in securing additional gas exploration blocks off the coast of Crete, Greece. This is part of its broader strategy to tap into new reserves and boost its already extensive portfolio of energy assets. The company's diverse operations spanning oil and gas exploration, refining, petrochemicals, and even renewable fuels make it well-positioned to leverage these new opportunities should they prove fruitful. What makes this development significant for investors is that Crete has become a hot spot for natural gas exploration in the eastern Mediterranean, an area increasingly seen as a critical region for future energy supply. If Chevron is successful in these exploration efforts, it could unlock significant new reserves, further strengthening its position in the natural gas market, which is an increasingly important sector as global energy demand shifts toward cleaner, more sustainable fuels. While this is still in the early stages, Chevron's proven track record in managing complex international projects means that any success here could have long-term benefits for the company's bottom line. For investors, this is something to keep an eye on, as any successful discovery or development of these new blocks could provide solid returns, pushing Chevron's stock performance even higher. As always, though, the risks are there, but Chevron's strategy shows it's willing to innovate and diversify its assets, making it one to watch closely in the coming months. Our review on KVUE, Kenvue Inc., a global leader in consumer health, continues to make waves in the market with a solid track record in managing debt, all while keeping an eye on future growth. Recently, Kenvue's debt situation has been under the microscope, and the good news for investors is that it seems to be handling its liabilities with a reasonable level of caution. As of late 2024, Kenvue had around $8.5 billion in debt, but with $1.07 billion in cash. This brings its net debt to about $7.4 billion. This may sound like a lot, but when you consider Kenvue's $44.6 billion market cap, it's clear the company has room to maneuver. The company's balance sheet shows a healthy mix of short-term receivables and cash flow, with liabilities spread out over the next year and beyond. With a solid debt-to-EBITDA ratio of 2.1, Kenvue is using its debt responsibly and its ability to cover interest payments, with an interest coverage ratio of 7.8, indicates that there's no immediate cause for concern. While debt always carries some risk, Kenvue's track record in managing its financials and its ability to generate free cash flow puts it in a strong position to weather any financial storm. On top of that, Barclays has just raised Kenvue's price target from $21 to $23, which gives investors a bit more optimism moving forward. This hike comes despite some expected headwinds, like slower consumer demand in the U.S., showing that Kenvue's fundamentals still shine through. With a stable balance sheet, a strong position in the consumer health space, and reasonable debt management, Kenvue looks well prepared to face whatever comes next. Investors should keep an eye on how the company kicks off Q1 earnings. Any positive surprises here could further strengthen the outlook. Our review on MO. Altria Group Incorporated, a major force in the U.S. tobacco industry, has long been associated with iconic brands like Marlboro, Copenhagen, and Skoal. However, with the steady decline in smoking rates, the company has been shifting its focus toward non-combustible products, including oral nicotine pouches and e-vapor products. This strategic pivot is crucial as Altria looks to stay relevant in an evolving market. That said, the transition hasn't been without its challenges. The company's e-vapor products, marketed through its NJOY subsidiary, face increasing regulatory scrutiny, particularly with concerns over their impact on public health. This added layer of risk could slow growth in the newer segments, making it an area for investors to monitor closely. At the same time, Altria's traditional smokable products, including cigarettes and cigars, still generate substantial revenue and cash flow. This financial strength provides a solid foundation for the company to invest in its future, whether that's expanding its smokeless product offerings or navigating the regulatory hurdles in the e-vapor space. For investors, Altria's ability to manage this transition while continuing to generate cash from its legacy business will be key. The stock's performance will likely depend on how effectively the company adapts to the changing market dynamics and regulatory environment. While Altria's future may seem uncertain, it has the resources to make it through this shift. Investors just need to keep a close eye on how it all unfolds. Our review on NEE. NextEra Energy Incorporated stands out as a key player in electric power and energy infrastructure, with a strong emphasis on renewable energy. The company operates through Florida Power and Light, one of the largest utilities in the U.S., and its clean energy-focused subsidiary, NextEra Energy Resources, which focuses on wind, solar, and energy storage. In the past month, NextEra's stock has dropped about 3.8%, underperforming both the broader market and its sector. This dip comes despite its consistent earnings growth projections, with expected earnings of 99 cents per share for the current quarter, reflecting an 8.8% increase from last year. However, the company's revenue took a significant hit, down 21.7% from last year and falling short of analysts' expectations. While NextEra beat earnings estimates, the revenue miss raised some red flags for investors. From a valuation perspective, NextEra is currently trading at a premium compared to its peers, which has led to a derating in its value score. This suggests that the stock may be overpriced relative to its growth prospects, potentially limiting short-term upside. That said, the company's long-term growth story in the renewable energy space still holds strong appeal. The stock holds a hold rating, meaning it's expected to perform in line with the broader market for now. In conclusion, NextEra Energy offers significant potential for long-term investors looking to tap into the clean energy boom. But in the short term, investors should be cautious of the premium valuation and some of the recent revenue struggles. Our review on EXC. Exelon Corporation is a major player in the utility services sector, providing energy transmission and distribution through subsidiaries like Commonwealth Edison, PECO, and Baltimore Gas and Electric. The company's reach covers electricity and natural gas across a significant portion of the U.S., and its focus on keeping the lights on for millions of customers makes it a vital part of the energy landscape. Recently, Exelon caught the attention of Argus Research, which gave it a buy rating with a target price of $45. While that's up from its current price around $42.76, there's still some room for growth. The stock has fluctuated between a one-year high of $45.20 and a low of $34.01, which means it's been navigating some volatility lately. One thing to keep an eye on is the insider sentiment. Over the last quarter, there's been a noticeable uptick in insiders selling their shares. For example, David Glockner, an EVP at Exelon, recently sold over 6,000 shares. While insider selling doesn't always indicate trouble, it's something investors should consider, especially with the stock being relatively flat recently. Overall, Exelon's fundamentals are solid, and the buy recommendation from Argus suggests that, despite some insider selling, the stock has potential to continue trending upward in the near future. But with its price teetering around the mid-$40s, it's essential for investors to keep an eye on these developments and make sure they're comfortable with the potential risks. Our review on QFIN. Qifu Technology Inc. is an investment holding company that's been making waves in the credit technology sector. The company's main business revolves around offering credit-driven services, like matching borrowers with financial institutions and providing post-loan services, as well as platform services that help with everything from loan assistance to risk management software for financial partners. Recently, Qifu got some positive attention from analysts, including Emma Sue from Bank of America Securities, who reiterated a buy rating on the stock. She also raised the price target from $50.66 to $52.70, signaling confidence in the company's potential for growth. This optimism is fueled by several strategic moves, including a significant offering of convertible senior notes. This move will fund a new share repurchase plan, which should not only boost earnings per share, but also help reduce the risk of dilution. Always a plus for investors. Qifu's strong quarterly results and its positive outlook for the future are also making waves. The company's high return on equity and solid capital return reflect healthy financials, which combined with the favorable market conditions in China, make it look like a promising growth story. With a solid growth trajectory and strategic financial decisions in play, Qifu Technology seems well-positioned to continue gaining investor confidence, making it a stock to keep an eye on if you're looking for a solid bet in the credit tech space. Our review on KHC. Kraft Heinz is a giant in the food and beverage world, with some of the most well-known brands like Heinz, Oscar Mayer, Kraft, Velveeta, Lunchables, and Kool-Aid. They've got a big global reach, and they focus on 8 major product areas from easy meals and snacking to coffee and hydration. The company operates across North America, international developed markets, and emerging markets, which gives them a lot of flexibility to reach different kinds of consumers. Lately, Kraft Heinz has been making some smart moves, particularly by zeroing in on improving their product offerings in taste and convenience. This fits perfectly with the way consumers are trending. People want quick, tasty meals, and Kraft Heinz is positioning itself to deliver that. Their strong brand names are already pretty established, so this strategy could really help them grow even more. Financially, the company has been working on streamlining costs which is key for staying competitive in a space that's seeing inflation and rising production costs. The good news for investors is that Kraft Heinz's well-known brands and global distribution mean they've got a lot of room to keep growing, especially as more people turn to convenient food options. That said, the competition in the food industry is tough, and inflation could put some pressure on margins. But with their solid lineup of products and a huge consumer base, Kraft Heinz is definitely a stock to watch. It'll be interesting to see if their focus on convenience and taste leads to more growth. Please subscribe, give the video a like, and watch more from our playlist. Thanks!